So the big question is this: how do investors like us who trade options and manage our own money generate income regardless of where the stock market goes, and do it all in a way that lets us make time for the people and things we love, and yet still build wealth and remain profitable? That's the question, and this podcast will give you the answer. I'm your host, Kirk Duplessis, and you're listening to The Daily Call from Option Alpha. Hey everyone, this is Kirk here again from Option Alpha, and welcome back to The Daily Call. Today we're going to answer the question, why trade single options versus option spreads? So I think this question really boils down to a difference of risk and reward. So when you trade single option contracts, or you go naked, and that's whether you buy a call or buy a put, sell a call, sell a put, in any case, whether you do a single option trade with no spread attached to it, you are sacrificing a little bit more capital potentially for the possibility of a higher return and for a shorter trade duration. So for example, if we sell a call option, we are selling pure options. We don't have to buy anything. So it doesn't reduce the credit that we took in from selling that call option, but we do have to put up a little bit more capital to do that. So that's the trade-off. That's the risk and reward aspect. And we potentially could be holding the trade for a shorter duration, because if the stock moves down or implied volatility moves down, it's going to dramatically impact that short call option in a positive way, which means that we could exit the trade a little bit faster. Now, these are all good things, obviously, if you're selling naked options or single legs, but when you're using spreads, you have the ability to control risk a little bit better, and potentially that means that you have to hold trades a little bit longer. Now, it doesn't matter which way you go necessarily. There's obviously pros and cons to each side of it, but with option spreads, because you are buying options, that means that you're taking in a differential between selling one contract and buying another. That means that when implied volatility drops, it has a positive impact on one and a negative impact on the other. Now, net, it should still help out as an option seller, but that means that positions are going to move a little bit slower. So you potentially have to hold them a little bit longer than you might if you were just trading single options. And it also, though, allows you to control risk a little bit better. And that means that you have potentially lower reward, right? So it's all kind of fair and balanced. When you trade an option spread, you have defined risk. You know exactly how much you're going to lose or how much you're going to make on that position. But because you have defined risk, the benefit of having defined risk means you have to give up something else. And so in that case, because you had to buy an option contract as a part of a trade, sell one and buy another, by giving up the risk component and defining your risk, you're also giving up the potential to make a lot of money. So option spreads have generally lower net credits, naturally, because you have to buy the other side, and also lower P&Ls on average compared to single option strategies. So again, it depends on the type of account that you're in and kind of how you see risk. We trade a lot of spreads, but we also have a handful of single naked positions in our accounts every single month. So we try to do a little bit of both and kind of a good mix depending on where implied volatility is. But hopefully this helps out kind of understanding the differences between each of these types as a general category. As always, if you guys have any questions, let us know. Until next time, happy trading. Thanks for joining us on The Daily Call. Be sure to subscribe right now for more daily options trading ideas, strategies, and tactics to help you learn how to place smarter, more profitable trades. And if you like what we're doing, don't forget to give us a rating and a review so we can continue to bring you the best daily content possible. We'll see you again tomorrow, right here on The Daily Call from OptionAlpha.com.